We're analyzing Walmart, stock ticker WMT, to see if Walmart's a great business on sale. This analysis is around 10 minutes. It's going to be intense, but it's going to be worth it. We're using the Select 6 analysis to look at the most telling financial metrics before estimating a fair value for Walmart. Then we're giving a final rating to the business. There will be a key bonus metric along the way that just might be the tipping point when analyzing Walmart for your stock portfolio. Before we get into these valuable metrics, let's understand Walmart's stock performance. Right now, Walmart trades for $159.18 per share. Year to date, their stock price is up 11%. While this is up, this is underperforming the market. Right now, Walmart pays a 1.41% dividend yield. Walmart's a newly crowned dividend king. They've grown their dividends for each of the last 50 years, putting them in very select company with other well-known companies like Coca-Cola, Procter & Gamble, and Johnson & Johnson. In the last 5 years, Walmart stock is compounding at 11% annually. In the last 10 years, they're compounding at 8% annually. Going back before the global financial crisis, in the last 18 and a half years, Walmart is compounding at 6% annually. Their average dividend yield throughout this time is added to these returns in their stock price. Right now, Walmart trades $3 below their 52-week high. Walmart's up $30 from their 52-week low. Less than 0.5% of their shares are sold short. Walmart is one of the biggest businesses in the world. They're one of the world's largest employers. They have a $431 billion market cap. But the burning question is, why should we be paying close attention to Walmart? Walmart serves as the preeminent retailer in the United States, with its strategy predicated on superior operating efficiency and offering the lowest priced goods to consumers to drive robust store traffic and product turnover. Walmart augmented its low-price business strategy by offering a convenient one-stop shopping destination with the opening of its first supercenter in 1988. Today, Walmart operates over 4,700 stores in the United States, plus 600 Sam's Club locations, and has over 10,000 stores globally. Walmart generated over $420 billion in domestic namesake sales last year, with Sam's Club contributing another $84 billion to the firm's top line. Internationally, Walmart generated $100 billion in sales. The company serves around 240 million customers globally. Now with that understanding, let's get into the numbers. Starting with metric number 1, we want Walmart's average return on capital in the last 5 years to be above 14%. The average business earns around 7% returns on capital. Looking for a benchmark that's double this can build in margin of safety based on the quality of the business. Walmart's earned very steady returns on capital in the mid-teens throughout all 5 of these years. They earned 16% returns in their most recent fiscal year. When these are averaged out, Walmart earns 14.5% returns on capital in a given year. That's just a bit above the benchmark we're looking for, meaning this is a check on metric number 1 for Walmart. They earn above average returns on capital. Metric number 2, we're looking for growth. We want to see 5-year revenue, net income, and free cash flow growth. All 3 need to be up for this to be a check. This metric's all or nothing. We'll include their last 12 months worth of numbers when we calculate this growth. In this time, Walmart's grown revenues 21%. Their earnings look like they've almost doubled. This is because Walmart had losses on a sale of assets and investment sales in 2019. When we back those out, their earnings are still up, but haven't grown by that much. Finally, Walmart's grown their free cash flows by 12%. Walmart's grown across the board here, meaning this is another check on metric number 2. We're 2 for 2 so far. Metric number 3, we're looking at Walmart from the view of an individual shareholder. We want to see earnings per share growth in the last 5 years. We learned Walmart's earnings are up over this time. In these last 5 years, Walmart's also bought back 7% of their shares. This increases existing shareholders' ownership percentage in Walmart without them having to spend a dime. Also worth mentioning, the Walton family has a huge stake in Walmart still. They wouldn't want to do any capital allocation policies that would hurt long-term shareholders. It's good to see Walmart's not diluting shareholders. Whether these buybacks create or destroy value for shareholders ultimately depends on Walmart's value. We're using 2 different methods based on Walmart's free cash flows to estimate their fair value later in our analysis. Either way, because Walmart's earnings are up and their shares outstanding are down, this is a check on metric number 3. Walmart's grown their earnings per share. They're perfect on our analysis so far. Metric number 4, we're looking for something similar. We want to see 5-year free cash flow per share growth. This is almost the same story. Walmart's grown their free cash flows and they've decreased their shares outstanding, meaning Walmart's grown their free cash flows per share. With a check on metric number 4, to recap, Walmart's perfect through our first 4 metrics. Can they keep this up? But there's still one vital piece missing. You might think having good returns and good growth is the key, but we haven't touched on the one thing that I believe sets Walmart apart, which is having these without using a lot of debt. Metric number 5, we want Walmart's net debt, which is their total debt minus their cash and their short-term investments, to be below the sum of their free cash flows in their last 5 fiscal years. Walmart ended their last fiscal year with $52.5 billion in net debt. Right now, they have around $55.5 billion of net debt, so they've slightly added to this. In these last 5 fiscal years, Walmart's generated $80 billion worth of free cash flow. The company had a very good year in their fiscal 2021, which encompassed most of the lockdowns. Since then, Walmart had to work through some supply chain issues and carrying excessive inventory, but their free cash flows today are above where they were at in 2019. Because they generate so much cash compared to their net debt position, this is a check on metric number 5. Walmart seems to be in a strong financial position as they're using a modest amount of leverage in their business. Walmart is flawless through our first 5 metrics. Does the business have what it takes to be a perfect select 6 stock and go 6 for 6 on our analysis? Let's find out right after we cover our bonus. As our bonus, we're looking at Walmart's dividend profile. Walmart is a newly crowned dividend king that right now pays a 1.41% dividend yield. People make mistakes all the time by blindly chasing dividends. Even with this track record, we want Walmart's dividends to be supported by their free cash flows. It's no surprise, with Walmart growing their dividends in each of the last 50 years, they've grown them in each of the past 5 years as well. In that time, Walmart's also easily supported their dividends using their free cash flows. They've maintained a reasonable dividend payout ratio throughout this time. That's the case today as well. While this is a snapshot of their last 5 years of performance and it's no guarantee for the future, this is a check on our bonus, as Walmart seems to use moderate leverage and has a modest policy of returning capital to shareholders. Now it's time for evaluation methods. The big metric of them all, metric number 6, we want Walmart's average 5-year free cash flow divided by their enterprise value to give us a yield that's above 5%. If this is the case, this gives a slight risk premium to the yield of the 10-year treasury. It's the first of 2 different ways we're estimating a fair value for Walmart. Right now, Walmart has a $493 billion enterprise value. This accounts for both their market cap and their net debt position. It looks at Walmart similar to it being a private company. In the last 5 years, we learned Walmart generated $80 billion of free cash flow, meaning they generate around $16 billion of free cash flow in an average year. When that's divided by their enterprise value, we get a 3.2% average free cash flow to enterprise value yield. On a current basis, Walmart generated $19.5 billion of free cash flow in their last 12 months. When that's divided by their $493 billion enterprise value, we get around a 3.9% current free cash flow to enterprise value yield. That's about right in line with the yield of the 10-year treasury. Both of these are below the risk premium we're looking for, however, meaning coming in all the way on metric number 6, this is our first and only X of the day on Walmart. Don't just throw this business out. We still need to estimate their fair value per share. Everything we've discussed so far is important, but there's something missing that in my opinion is the main reason to analyze Walmart, which takes us on to using a discounted cash flow model to estimate Walmart's fair value per share, A DCF model is based on the predictability of a company's free cash flows. Like any model, its outputs are sensitive to its inputs. Walmart's had a low degree of business predictability in their past decade especially. The company's seen pretty fierce competition from digital retailers. They also had a whirlwind of high demand and low inventory during lockdowns, followed by overstocked inventory which they've had to work through. This all affected their business predictability, which can impact our assumptions. To better normalize their free cash flows, we're starting with an average of Walmart's last 3 fiscal years worth of free cash flow, then using historical assumptions to grow these into the future. It's up to you to figure out if these will be accurate or not for Walmart. Assuming Walmart grows their average 3-year free cash flows by 5% annually for the next decade, then assuming in the following decade that these grow at 4% annually, we're adding in Walmart's tangible book value to give an estimate of their net worth. This may be slightly understated due to their share buybacks and how the accounting is done for those. That's something to make note of. If we want a 15% rate of return, which is what Warren Buffett looks for from his investments, from today's valuation multiples, if these are the same 20 years into the future, An estimate of Walmart's fair value per share is just below $67. That's down less than half from their current stock price. Keep some key points in mind. There are a few reasons Walmart's been less predictable in recent years compared to the real growth stage of the company. Walmart also seems to be trading for some generous multiples. This discount rate outpaces how Walmart would have performed in their last 2 decades by quite a bit. It would be an estimate of total returns to shareholders in the next 20 years, including both their dividend yield and any gains in their stock price. Most importantly, this analysis is not financial advice. It's not a buy or sell recommendation of any security. Consult with your financial advisor before making any investment decision. In just a minute, we'll talk about our final rating for Walmart, but we need to address something first. We've covered the numbers, but the qualitative factors may be even more important for Walmart's business. Let's find out what they are. Starting with the factors supporting a long thesis. Number 1, Walmart's recent investments in supply chain automation should drive margin expansion. The firm may also reinvest the cost savings to hold down prices and drive foot traffic to its stores, a competitive benefit relative to many smaller retailers. Number 2, Walmart's vast grocery offering can insulate the firm from digital competition, given the perishability of the merchandise. Number 3, margin pressure may abate as Walmart's recent investments in omni-channel fulfillment and its third-party marketplace continue to scale. But it wouldn't be fair if we didn't cover the negatives of Walmart's business as well. Looking at the factors supporting a short thesis. Number 1, Walmart's sales mix of higher margin general merchandise categories stand to decline due to strong digital penetration, potentially prompting long-term margin declines. Number 2, Sam's Club has woefully underperformed Costco in recent years, and the brand does not provide a compelling value proposition that would allow Sam's to take share. Number 3, Walmart's third-party marketplace and third-party fulfillment capacity pale relative to Amazon's scale. Amazon may underprice Walmart on commissions, listing fees, and fulfillment services related to its own marketplace. There you have it for some of the qualitative factors of Walmart's business. Now it's time to give our rating. In analyzing Walmart, stock ticker WMT, this discount retailer fared very well on our analysis. They earn above average returns on capital, they've grown, they've bought back shares, they use a modest amount of debt compared to the free cash flow they're generating. Walmart's also a dividend king, growing their dividends in each of the last 50 years and supporting these using their free cash flows in the last 5 years. The history of Walmart and its operations is fascinating. I highly recommend reading Sam Walton's autobiography, Made in America. It's a fantastic recollection of the Walmart story and basically served as Jeff Bezos's future blueprint for Amazon. Again, this analysis is not financial advice. Right now, Walmart's free cash flow to enterprise value yields don't look attractive compared to the yield from the 10-year treasury. When we performed our discounted cash flow analysis, if today's potentially generous valuation multiples are the same 20 years into the future, you believe those assumptions and you want a 15% rate of return, an estimate for Walmart's fair value per share is right around $67. That's down a lot from their current stock price. Walmart last traded near those levels in January of 2017. Back then, they had different results for the business as they've continued to grow and scale. Looking at all the factors of our analysis, Walmart looks like a modest candidate for further research. If you enjoyed today's video, be sure to like it, subscribe to the channel for more stock analysis videos, share your thoughts about Walmart, and let me know what business to look at next in the comments below. Thanks for learning about Walmart with me, and have a great day.